I made over $100,000 day trading in just 30 days, but it wasn't always like this. And I've actually been trading for the last 6 years and only recently became profitable. And in this video, I'll be revealing the exact steps I took that allowed me to achieve this. And these are steps that you can literally just copy. Right here, you can see I received a $56,000 payout from TopStep. And right after that, went to Miami, hung out with some of my trading mentors, switched up on my day ones. But before I show you the steps, I gotta be real with you. I went through years of over trading. I was forcing trades, blowing accounts, losing a lot of money. And really, that was the problem. I was focused on the money. I would go on the internet and I would see all these traders flexing cars, just living that luxury lifestyle, traveling. And it really skewed my mindset on what I was actually trying to achieve with trading. And once I started to change my mindset, this was the turning point. If you don't change your mindset, your trading will never work. And here are some things that you can do to change that mindset. And number one being is remove that ego. This is something that most traders get stuck, and you think that every loss is the end of the world, that you'll never figure it out, or you have to switch up your strategy, or every win that you take makes you a genius. When in reality, even if you're going on a win streak or not, the market has a funny way of humbling you when the market doesn't care who you are, and it rewards that discipline and not ego. And so really just detaching from needing to be right and focusing more so on executing right and following your system, and basically just making sure that when you're taking trades that they align with what you're looking for in trading. Next would be to focus on the process of trading. I started growing once I stopped chasing those results and I started doing repeatable actions through discipline. Trading is ultimately boring. You need to fall in love with the consistency and basically doing the things that what I see most successful traders do, and what has helped me find success in the markets. And just by managing risk or journaling every day, following my rules. Those are the most basic things that you can do to focus on that process. And if you just do that, I promise that you will start to see some sort of results in your trading. And something that I kind of live by when I think about trading is it's a you versus you mentality. And basically you need to master yourself. You're not fighting the market, you're fighting yourself and your impulses, your emotions, and your impatience. Trading is something that will teach you a lot about yourself. And if you can't master where those bad habits are, this won't work out for you. And something that you can do to help identify some of those bad habits is simply just by journaling. That alone, and going through your journal and actually reviewing it, that alone will really help you learn and be able to adjust to where you're lacking. And yeah, essentially, if you can't master yourself and where your impulses are, trading won't work out for you. The next thing that has really changed my trading and helped me find success is risk management. This was probably what I felt like was the missing puzzle piece to who I am as a trader. I would have boom and bust days. I would have crazy winning days and blow it all up. If you can't manage your risk, then you can't profitably trade. I lost the most amount of money when I was not managing my risk at all. I was full porting 0-day contracts, and yeah, I was just being dumb. I was making plays I knew I shouldn't be making, and I was trading like a degen. And here are kind of some things that you can do to prevent that. Number one, don't place risky trades. Only place trades that line up perfectly and you're confident will work out. Basically what I mean is don't trade in between the lines. If you're trading and the charts aren't giving you your type of conviction on things that you're looking for, why put the risk on? Why even take the risk on something that you're not confident in? If you're taking trades where you're not confident, you're already emotional. Your emotions are all over the place. And what helps me is taking trades that line up perfectly with my system and my strategy. And if I lose following my strategy, I don't care. But one thing I don't want to do is place a trade that doesn't even align with my strategy. If I have no conviction, I feel lost, and that's when I get emotional and I'm not confident in direction, or it just gets real sloppy. So I don't recommend just placing a trade because you feel like it. But next would be to trade small. If you're dealing with $1,000 or $10,000, like don't full port your account. And this is something that I dealt with. Like when I was talking about going through my boom and bust stages, I ran up $100,000 from 25K trading options, and by any means, it wasn't in a good way. I was being a degen. And in one day, I lost half of the account because I full ported FOMC. And so once I lost that whole account, essentially it set me back 6 months because I didn't want to look at another chart. And so things that you guys can do to avoid that is just don't full port. Only risk 1 to 2% of your account size per trade. And those small wins add up. Like, you don't need to hit a home run. It's those small cumulative wins will help build that psychology and help build that confidence. And same thing with taking payouts on prop firms. Even though you might only be getting $500 days, those $500 days add up. 5 times 5. That's if you can do $500 a day, that's $2,500 a week. I mean, that's more than what your average person is making in the job market. Next, you need to handle your losses properly. If you lose, then take a break, take a breath, like reevaluate what the market is doing. Ask yourself, why were you wrong? You don't want to revenge trade and try to make your money back. Referring back to when I blew up my options account way back in the day, I took a big loss on FOMC. I didn't lose it all in one day, but just the emotion of losing all of that money had me trying to revenge trade. I'm like, oh, let me just make that loss back. And then all of a sudden, here I am, risking more than I need to, just trying to make back what I lost and what had taken me 3 months to build up just to lose it in one day. And eventually you start spiraling, you start going down, and then eventually, boom, your account's gone. So as long as you can keep yourself afloat, and that's what that trading small will help you do, like by only risking 1 to 2%, like that will help you keep afloat. Whether you take a loss or not, like if you lose 1% of your account, you have 100 more tries on that account before it's gone. And there's no saying that you're going to just lose 100 times in a row. And if you do, then it might be a different problem. But yeah, basically just don't revenge trade. Don't try to make your money back after taking a loss. Focus on the new day. Focus on new day, new trade. Don't worry about what happened yesterday. Don't worry about what's going to happen tomorrow. Just focus on what's in front of you today. So before we hop on the charts, let me talk a bit about my trading setup. And what I use to chart up my stuff would be TradingView. And this is just a separate app that you can get, and you do have to pay like $15 a month for real-time data, but it's just a smooth software. And most of the apps that people use now, like they come with their own charting software, so you don't necessarily need it. But for me, I just like the way it looks, and I think it's really smooth. And for a brokerage, what's popular now is the prop firms, and I actually use Alpha Futures. And so if you guys are interested in prop firms or anything like that, I do have a few links in my description. Or if you're using personal brokerage, Interactive Brokers, I know a lot of people that use this one. It's really well, and it's trusted. And to help with my journaling, I use TradeZella. They have a really nice software as well. It shows where you're consistent at, and it shows you a lot about your trading. It tells you your win rate. It has your R collection. It shows how consistent you are. Yeah, I really like them too. So now that we got the mindset part of the video out the way, now it's time to discuss the actual strategy I used to make over $100,000 day trading in 30 days. So I'm going to go over the first thing that I do when I'm hopping into the market, and that is to find daily bias. And how you can do that, how you can find your daily bias is by going to the higher time frame highs or lows. And what I mean by higher time frame is like H4 highs or lows. You can go to your H1 highs or lows, and you can even go up to your previous daily high, previous weekly high, previous monthly high. Basically waiting for those higher time frame highs or lows to get tagged. And then on top of those, we also have our session highs or lows, our London session, our Asia session. And once we have our daily bias, this will really help you just determine the direction and the overall trend of where the market is going. And once we kind of mark out we have our daily bias, we have our high over here and we have our low over here. We just wait for one of those areas to get tapped. So number 2, wait for key level. We need to wait for our key level to get tapped. There's no point in just trying to trade in between the key levels. I feel like at that point, you're just kind of guessing, and it makes me a lot less confident in my trading. When a key level hasn't been tapped in yet, I feel like I'm just trading fluff, and normally those trades don't work out too well for me. So I think it's really important you mark out your 2 key levels and you simply just wait. And so once our key level gets tagged, then what we do is we drop to the lower time frames like M1 or M5, and we're not entering a trade just yet. We're watching what price is doing on that lower time frame. We have our higher time frame bias, and then we use lower time frame for our confirmation. So once we drop down to our lower time frame, what we want to see after taking a key level, what we want to see is swift rejection. We want to see, or what we're looking for is IFVGs. We want to see an IFVG after taking out a key level. And when I would say swift rejection, we're looking for that displacement. We want to see price reject that key level. That's the whole point of this model, is we're looking for reversals. So we're looking for that swift rejection. We want to see that IFVG form on M1 or M5. And then that's really all it is for conviction to enter that trade. We draw out our daily bias, we wait for our key level taps, and then we drop to our lower time frames, M1 or M5. And then we're watching, what is price doing? Is it accepting over that high? Are we displacing? Are we respecting fair value gaps, continuing along with the trend? And if that happens, then you simply just look left or look at a different higher time frame. Where is the market drawing to? And then with what we're looking for is that swift rejection, or we get that IFVG. This will help you find that reversal and saying that the market doesn't want to go up or down anymore, and now it is time to reverse. So once we get that IFVG confirmation, enter trade, and then put stops at most recent swing high or low, because we don't want to see, after we get our IFVG, we don't want to see price take a new high or a low, depending on if we're in buys or sells. And then optional, I would say this is optional. What you want to do is look for displacement. We want to see price. So we have our highs and lows. The market trades above the high, then we drop down to our lower time frame, we get our IFVG, and then we enter our trade, and we put our stop loss here. And then all we're looking for is the next set of liquidity. We're targeting opposing liquidity. And so I'm going to add that in up here, target opposing liquidity, because that's what the market is moving between. It's moving between highs and lows, and there's resting orders above highs or above lows. And so as soon as you get your IFVG, what you really want to see, but it's not necessary, is you want to see the market move swiftly away from this area, almost giving you that V-shaped momentum. And that will basically kind of give you extra conviction that price doesn't want to continue any higher. Like we take a key level, get that swift rejection, and then price starts aggressively moving away. Basically, people went long above here, and market makers came in, selling off the market, and everybody that went long up here put their stops down here. That's kind of the theory behind it. And so that's why we target the opposing side of liquidity. Like now that we've taken a key level, now we look for where is the next point of liquidity? Where could the market be moving towards? Since it didn't want to move above here, it has to move to some sort of sell side liquidity or higher time frame order flow, as in higher time frame fair value gaps, before continuing in the overall direction of the market. And so now that I kind of gave you the rundown of what I'm looking for when trading this strategy, now it's time to show you on the charts. So coming into today's session, the first thing that I would do is I would mark out my Asia highs and Asia lows, and then London highs, London lows. And since we are at all-time highs, we're kind of in price discovery mode. And so since the market is so bullish, really all you're doing is just looking for areas to long off of. And that's the overall bias of the market right now. And let's say we took these London highs and we inverted this fair value gap. Even though we're on H1, we took session highs. And so if we were to invert this fair value gap, then I would start to look down lower. Then I would start to target towards these London lows or look for other H1 or H4 fair value gaps. But if you look at the market opened up right here at 9:30, and here's our H1 fair value gap. And if we drop down to the lower time frame, we are in that higher time frame fair value gap. And so right here, we tapped into that fair value gap. And we inverted this one, and ultimately that one didn't work out. But that is also why it can be important to wait for at least market open, because there's a lot of volatility from there. And so another key thing that I look for is a lack of displacement. Notice how NQ just made a wick below this area. It didn't get no candle closes, didn't invert this fair value gap. And so that is very key for me, is noticing that lack of displacement on that higher time frame. And then if we drop down to the lower time frame, we're in that higher time frame fair value gap, and this is just on today's price action. We'll go over some better examples in a minute here, but here's market open. We took out highs right here. We instantly inverted that fair value gap. And what did the market do when it came under this area? We're in that higher time frame fair value gap. Here's our IFVG here. And so this one kind of played around a little bit, and it could be due to what we have going on this week, like FOMC and stuff. But you would enter here and put your stop loss here. And since we are in price discovery mode, it gets hard to choose where to target. So I don't think that this is the best example, but just by seeing off of that higher time frame, there was your entry. And as long as price didn't make a new low, this is where you could begin to drag your TPs up and identify like what price is doing on certain time frames, and essentially just trail your stops up. Because once we started displacing highs, we started creating fair value gaps. And even though it looked choppy on the lower time frames, if you just look at H4, we created H4 fair value gap. Like the market is displacing up on that higher time frame, but it begins to look a little bit messy when you're looking at that lower time frame. Let me show you a better example of something that I took during the previous week. And if we go to H4, we had this big move down on Friday. And what did the market do when we came under this H4 low? We lacked displacement at this low. And so let us drop down to a lower time frame. We'll go to M1. We've taken that H4 low, which was also Tuesday's low. So we took that H4 low, and then look at what price did. So we swept that low. There's no clean IFEGs here on M1. So let's look at a different time frame. Let's check out M5. Okay, so there wasn't any clean fair value gaps on M1 or M5. I use M1 through M5. Like it doesn't necessarily have to be any certain one of those time frames. It's essentially just dropping to that lower time frame. And the key for me was just that we took that low and then the lack of displacement. We didn't get any candle body closes on that higher time frame. So we swept that low. We have our 3-minute IFVG right here. And so look at what happened when we took that low. We started creating bullish fair value gaps from that low, inverting bearish fair value gaps. And that's really the bread and butter of it. You enter in as soon as you get that candle close through the IFVG, you put your stops at the swing low, and then simply you can target London highs, you have Asia highs. But since we took an H4 low, then you could really start to target up higher or previous daily high, and really just managing your trade as you come up into points of liquidity. Like I'm sure there's some bearish fair value gaps that we came into, and that's when the market decides to consolidate. But essentially that's really it. You wait for that key level tap, which was that H4 low. You get your inverted fair value gap. The market is giving you fair value gaps from that area, and then respecting them, respecting the inverted fair value gap, failed to make a new swing low, and then came to opposing sides of liquidity. And so just managing your trade as you move up into profit, because unless you want to hold it throughout the night, but the most important part is to take profit at points of liquidity, whether it's session based or order flow based. Like right here is an area where I potentially would have considered taking some profit, because now we're moving into some 15-minute bearish order flow, or at least raising my stops up a little bit to manage risk, because this is an area where I could potentially see the market reject from. But then even if we're looking at M15, what are we doing right here? After taking that low, we lack displacement. We have M15 fair value gap right here. The market is creating bullish fair value gaps from that area. And this is something that I'll do to kind of give me more conviction or more confidence in my trade, or something that allows me to feel comfortable holding longer, because we took that low, we're creating bullish fair value gaps even on M15, and we're disrespecting bearish order flow, or we're disrespecting these bearish fair value gaps, and we're getting full displacement to the upside. And typically what you'll see is you'll get your Asia range, London will manipulate one side of the range, and then you target the opposing side of that Asia range. And so that's pretty much it. Like that's what I do every single day. A lot of times for intraday price action, a lot of what I use is just session-based liquidity, but that is the most detrimental piece of this model, is waiting for that sweep of liquidity. I mean, even here, when we had that big drop on Friday, look at what happened. We came to this weekly low also while coming into a weekly fair value gap. And since it did that all the way into close, it was a little bit harder to catch. But what did the market do as soon as it took out this low and came into that higher time frame objective? We bounced up 500 points. And then, we kind of chopped around throughout the day. And then look at here. So here's our previous daily high. And what did the market do? This is all on H1. So we identify we have our H1 fair value gap. Let us drop down to a lower time frame. And this was during the Asia session, so most people probably wouldn't have caught this one. But we came above previous daily high. We have all that higher time frame order flow in the way. And so it gets a little bit trickier when you're on that lower time frame and you're trying to catch that reversal, especially when we have fair value gaps going through that high. Like on this time frame, it looks like we're displacing. And then what you would want to see is us respect these fair value gaps and continue with the trend. But that's not what happened. Instead, we inverted those fair value gaps. And for extra confirmation, like you could have entered in on M15 once we started to invert those. But for me personally, I would have been looking for more like H1. Like, again, this is how you can use that higher time frame to kind of build a bias on where the market is moving. And so for the London traders, they could have identified this. And what you would do is we have our previous daily high sweep. We have our inverted H1 fair value gap. And so like this would be more of like a swing idea because we're using more so the higher time frame. As long as the market doesn't make a new swing high, the trade idea is valid. And then once you enter from there, what you would be targeting is session lows or Asia lows that are right here. We had our new week opening gap. Like there's clear targets on where we could potentially take this trade idea to. So this one did end up coming to Asia lows. And me, who's normally trading a New York market, what did the market do when we came down into these lows? On the H1 time frame, we're lacking displacement. The market is showing me that it doesn't want to continue lower. And so from here, once I realized that we're coming into this gap, we're failing displacement at the lows, then drop down to a lower time frame. Let's see what the market did right here. Okay, so even though you could have taken this one, this would have been a little premature because the market hadn't opened up yet. And so everybody that did end up taking this one, if they weren't managing their risk or putting their stops to entry, likely they got stopped out at open, and whether they re-entered the trade or not is up to them. But there was definitely enough profit that you could have made from there. But even here, okay, we get our lack of displacement at the lows. We came to those Asia session lows over here. And then what did the market do when it came into that area? We're creating those bullish fair value gaps. We're inverting bearish ones. And so once you get that, that's our signal. Okay, we inverted the bullish fair or the bearish fair value gap, stops at the swing low, targeting opposing side of liquidity. In this case, it's session based. The market is normally moving through session based liquidity, but there's highs in here everywhere on where you could start to take profit. And then just by looking at the higher time frame, we're also creating higher time frame fair value gaps from there. And then we're respecting them and continuing with the trend. Same here. We created another fair value gap. This is what you want to see when you're starting to hold your trades for higher targets. Rather than just take profiting here or here, we're creating those bullish fair value gaps. We're testing them. We're respecting them and then continuing trend. Created a bullish 15-minute fair value gap. A lot of people, price comes up here and they're like, oh no, I'm going to miss the move. When in reality, you should have gotten in down here, but the market retraces into those fair value gaps and then continues along with trend. What did we do from there? Created 15-minute fair value gaps and then kind of hung around because it was the end of the session, but ultimately ended up inverting all of those. Moving into that big drop on Friday, this strategy presented itself to take it all the way to the lows. What did we do here? We took our Asia session highs. So we mark out Asia, London highs and watch how the market reacts at those key levels. Let's take a look at H1 just to see. Look at here. The market lacked displacement on H1. We were failing to close any candles above this area, basically signaling that the market doesn't want to continue up. Now, if we would have created fair value gaps through this area on that higher time frame, you have clear targets to the upside. We drop down to M1 as we've taken our Asia highs. That's this dotted line right here. What did the market do? We are creating M1 fair value gaps. And when we're looking for this model, that's kind of stuff that we want to see. And then we also have an M1 fair value gap right here, but this would have been your signal. As soon as we started inverting those fair value gaps, and along with that, we have our H1 with the lack of displacement, that looks like an A+ trade to me. So you could have entered here, you could have entered in on the retest, but ultimately stops at the swing high. And this one did kind of hang around a little bit, but look at what happened. You could have targeted session lows. You could have targeted previous daily low over here. Like, these are all draws on liquidity. And then just by using our higher time frame as targets, we have these lows over here. We have these lows over here. And then if you were looking at the weekly time frame, like I was saying earlier, we had that weekly fair value gap. And so when you have those higher time frame fair value gaps, I mean, the market tends to trade into them. Like, the weekly ones get tagged a lot. And then again, what you're looking for is a reaction out of there. We took this low, failed to invert this weekly fair value gap, and then the market respected it. We came to internal liquidity, and now the market is starting to trend up. Even before that big drop here, we have our H4 fair value gap. Market trades into it. And like, even though this is such a higher time frame, we have H4 lows right here. And what did the market do when it got into this area? Like, this is an area, if the market is bullish and going to remain bullish, we look for the market to respect this area. And if not, if we took buy side liquidity over here, inverted a higher time frame fair value gap, this is where you'd start to look for a lower draw on liquidity. But that's not what happened. Instead, we came into that higher time frame area, and let's drop down to the lower time frame. So we have our H4 fair value gap. We drop down to M5. And then if you look here, this did happen at the end of the session, so it would have been a little harder to catch, but we took out sell side liquidity. We tapped into a higher time frame fair value gap. And what did the market do when it got in here? We started getting displacement candles away. We started creating bullish fair value gaps. This is what I look for when I'm looking for displacement in the opposing direction. And then we start inverting bearish fair value gaps. So then what you could do is, this trade did end up going overnight. So unless you, on prop firms, it wouldn't allow that. But if you were in a different position, I wouldn't necessarily recommend it. I would more so wait for that Asia open. But your stops at the swing low, targeting opposing liquidity, as in previous daily high, because we're getting that H4 reaction. We're tapping into a higher time frame fair value gap. The market is ultimately bullish. And then if you would have just longed in here and swung it overnight, it goes straight to previous daily high. And then what did the market do? I mean, just going into the next day, here's our previous daily high right here. Draw out our previous daily high. The market then trades up into this area. So we've came above previous daily high. Here we have our inversion. I'm sure if we drop down to M1, it would get a little bit cleaner and we'd be able to manage our risk a little more. But we took out previous daily high. Now let's just target session lows. That would be the theory or the idea, but we have sell side liquidity all through along the way. And so what happened when the market came here? We are lacking displacement at the lows. And so this is where you have to be managing your trade. When you start getting these long wicks, basically showing that price doesn't want to move down anymore, that's when you start to take profit, because ultimately you would have gotten stopped out if you would have been targeting down here and didn't manage your trade at all. And then from here, what did the market do? We lacked displacement. We took sell side liquidity here. Then we dropped down to a lower time frame. Monday the 6th. Okay, so we took that low on M1. We did have an IFVG here, and this one did end up failing because you would have entered here and been targeting up higher. But then we also tapped into an M1 order block, started rejecting, and again, where it pays to identify what price is doing, even on the lower time frames, is what are we doing above here? We're lacking displacement above the highs. And as long as you have risk management and you're not oversizing on one account, this will allow you to, I guess, take this loss. If you take this loss and you have your stops down here, and if you have good risk management, again, we took sell side liquidity, we're lacking displacement at the lows, and then here's our fair value gap. So we take our fair value gap. This is a little small, so we won't not look at it. And so here's our entry. We have our inverted fair value gap here, stops at the swing lows, targeting opposing sides of liquidity. And so as the trade starts moving up towards these wicks, that is where you start to take profit or manage your trade, move your stops to entry. And so we took lows, we took sell side liquidity, we're lacking displacement to the lows, we have our IFVG, and then we start taking the trade to opposing sides of liquidity. Here we have these highs. This was for 1.7R, and then we have highs up higher. And so essentially, again, that's it. We sweep sell side liquidity. Doesn't always have to be into some higher time frame gap, but just by looking at what went on the other day, we came from that H4 fair value gap. We came above that previous daily high. We had entry models here that took us to this sell side liquidity, but ultimately we are bullish given what the higher time frame is showing us. So then what we do is we wait for sweeps of sell side liquidity and then start looking for longs, and then just more so reacting to what the market is showing us. If we would have continued displacing through these lows, if we would have continued creating bearish fair value gaps, then we could start to target down lower towards those London session lows. But that's not what the market did. We had lack of displacement, we had inverted fair value gaps. The market started creating bullish fair value gaps and started moving in the opposing direction towards buy side liquidity. So now that I've kind of shown you everything that I do when I hop onto the charts, I have a challenge for you guys. Try this for the next 90 days and you will start to see progress. And number one being journal daily. Like, I really challenge you guys to do this because these are all the things that are necessary to succeed in trading. And number one being the most important, journal daily. And again, I've said this before, this is where you're going to realize where you're messing up in your trading, where you need to improve on, and honestly, what you're doing right. Like, how do you know what you're doing is working if you can't use your data to analyze it? So I think that is very important. Next, and this is a personal favorite, but again, something that I do is meditate daily, and that just helps me get my mind sharp and ready. I feel like if I don't meditate, I'm very anxious, and I get a little anxious when I'm hopping into the market. So really just trying to do things that clear my mind and allow me to be sharp and focused when I step into the market. Next is set zero expectations. Win, loss, like, you have to not give a fuck about what is about to happen with that trade as long as you're following your system and you're reacting to what the market is showing you. Like, you can't expect, oh, I'm going to get a $50,000 payout because Jaden made this video and I'm going to kill it. Like, you need to have zero expectations and just focus on taking good quality trades. Don't focus on making that money. Next is master one strategy. Trade only one strategy for 90 days and see what happens. Just because it doesn't work on Tuesday or Friday does not mean that it's a failed strategy. Like, I know so many traders that only trade one strategy and they're killing it. Like, once you master one strategy and you trade one strategy, then you can start to expand your tool belt. But if you just focus on one strategy and get really good at identifying it, that's really all you need. And if the strategy doesn't present itself, you don't trade it. Next is become an observer. You don't necessarily have to trade every day. Just watch. Just watch what the market is showing you. If you're not confident in today's session, watch what the market is doing. Wait for those key levels to tap and just react. Like, not necessarily having to click buttons every day. I feel like 40% of the market, you're not even trading. You're just waiting for those key levels to tap and then watching what price is doing. Next is don't focus on the profits. I kind of already said that back here and set zero expectations. But when you start focusing on the profits, that's when you get emotional. That's when you start making mistakes and you start over leveraging or over risking, and you're more so focused on the money aspect of it rather than taking a good quality trade. And getting emotional, like I said before, is just not something that we want to do when we're trading. Then bad things happen. So over the next 90 days, I challenge you guys to journal, meditate, set zero expectations, master one strategy, just watch the market if you're just getting into it, and don't focus on the money. If you can do all of these things, I guarantee that you will find growth in the market and yourself. And so that's all I have for today. If you guys enjoyed this video, drop a sub, drop a like, and I'll see you next time. Peace.